Brian Belski is Chief Investment Strategist at Oppenheimer and Company. He is one of the 14 strategists of the major brokerages that Bloomberg surveys for their market outlooks, and he doesn't see the S&P 500 going much higher than where it is now. One of the reasons that I think our producer referred to you as a bear earlier and said, wait a second.
Not a bear.
I still see gains, but not big gains.
No, I think many of the people that do what I do can either be put in a perma bull or perma bear camp, and we think that.
And a lot of people are.
Yeah,
obviously.
Well, when we were at a prior firm, we were probably the most bearish person on Wall Street in 2007 and 2008, and then we became very bullish in 2009 and 2010, and maintained that all of last year. And if you take a look at how far the market's come, really, the last 2 years, we've doubled in price, right? And I think we've, as investors on the institutional side of things, I think we've kind of forgotten, frankly, that stocks are a leading indicator for the economy, right? And so stock market's been up 2 years in a row, double digits, and now it's the economy's turn this year. And I think why we're not surprised with respect to what happened to S&P today is, the market really poo-pooed the kind of soft economic news last week and really focused in on earnings. And we think that on a near-term basis, the market will remain quite reactive with respect to the daily gyrations of earnings reports. But by and large, this is really time right now that the economy better get going to see expansive gains from here.
Because what's more important? Is it corporate earnings or is it the economy in your view? Or, I mean,
well,
obviously a little bit of both, but.
It's the economy because right now, because it's, I like to call it the great circle of life, right? So if jobs come back, then growth will come back, and then people will feel better about housing and spending and all of this, right? So think about this. If stocks lead earnings, which lead the economy, right? Remember this. In 2008, stock market was negative, right? 2008, GDP was still positive. In 2009, markets were positive, GDP negative. Okay, so the stock market discounted what was coming. Now we've had this big move in stocks. Now the economy better get going. Corporate earnings, last year was the year of corporate America, right? Pristine balance sheets, double-digit earnings growth. In our report today, we show you a FY1 revision chart of all analyst estimates for the S&P 500 companies. It's at all-time highs, meaning up. So right now, if you take a look at that, you can use this notion we're priced to perfection in terms of earnings. That means earnings better come through better than expected, or else investors are going to say, hey, wait a minute.
Speaking of better than expected earnings.
Speaking of that, let me bring in Adam here, because Adam, you're looking at, if I'm not mistaken, bank earnings today?
I am. I feel like I'm in a broken record. And Brian, maybe you can help us make sense of this. Here's the situation. We got two more bank earnings this morning, KeyCorp and Citi, and it was very similar to what we saw last week with Bank of America as well as JP Morgan, in that part of the gains, a big part of the gain, actually had to do with an accounting change where you took money that had been set aside for bad loans, you put it back on the income statement, so it makes it appear as though they're earnings when really there weren't. So the question, Brian, is when do we actually get the earnings growth, or is that just a black hole that you can't quantify right now?
Well, it's really part of the situation that sets banks and financials apart right now, because from an earnings perspective and a valuation perspective, banks and financials have now become the quintessential, stock picker sector, where it's all over the place. You saw different levels of growth and earnings last week from different stocks, so you have to really focus on the individual stocks, number one. Number two, I think there's broader structural change coming in financials. All these budget concerns this year have just pushed off what's coming, and what's coming is major financial reform. So coming out of this, we think we're going to see, again, major periods of consolidation. We need to take some capacity out of financials. And quite frankly, to answer your question, at least much more succinctly, we need to see new areas of growth for financials, and we're not going to see that until we start to see loan growth, and that's still a ways off.
So would you stay away from the financials at this point?
We're market weight financials, and we're just picking particular areas within the brokerage firms, within the asset managers, and some life insurance companies, and very select banks, because all banks aren't created equal right now.
Brian, you just made a key point. We need to see new, effectively, profit streams for the banks. But if you've got Congress effectively saying you can't prop trade anymore, then how do they do it?
Well,
and putting a price cap on debit card fees, right?
Right. What's really interesting is I've gotten in the business in the late 80s, early 90s, and that was the time period of the S&L crisis, right? So following the S&L crisis, ROEs on the financials went from 3 to 21. 3 to 21, right? And then they kind of hovered in around 15% during this decade, that all the credit issues and these new derivatives and all this kind of thing. Now, we think ROEs are going to be high single digits at best, and we're still in this corrective way on how banks are going to, from an operating performance basis, drive growth going forward. It's clearly not going to be all from fees, because the more you fee people, especially in this environment with high unemployment, low wages, people are going to run away from the banks.
You know, obviously dominating the market today was this S&P move. I mean, do you think it gets much worse? Do you think we potentially see eventually a downgrade of the United States?
No, we're not going to. I don't think we're going to see a downgrade.
Smiling.
No, we're not going to see a default. These are one of these reactive periods. It should not come as any surprise that S&P talked the way that they did, because frankly, we do have problems with debt in this country. We know that, but it's not clearly, in our opinion, anywhere close to the potential issues that could bestow upon Europe.
So what are they up to in your view?
What I think they're up to is putting everyone in front of the mirror, saying we need to fix this problem. Okay, and so what's going to end up happening is you're going to have even more of a stronger microscope on the budget situation. You're going to hear more and more about fiscal solutions, less about monetary. Okay, and all of these things are going to be on the front burner heading into the third and fourth quarter, which of course pushes off all these other issues that we have to talk about: a potential health care repeal, financial reform, all of this, jobs, right? So this is going to be a front burner issue.
Tied in together?
Absolutely. And there was a comment made earlier about surprising dollar strength. Why should anybody be surprised about the dollar? Longer term, this is very good for the United States that we're putting a stronger microscope on what's going on with respect to the budget.
But clearly that's not the reason the dollar is gaining today.
Well,
nobody takes a look at this and says, hey, long term, this is great. I'm glad S&P brought it up.
Maybe the dollar's telling us something, though. And the dollar's telling us still, at the end of the day, yes, we have issues, but we're still the best house in a bad neighborhood.
You said it's good that we're probably putting U.S. debt under the microscope. Julie, I want to bring you into this because you're really looking at the debt of other nations, kind of putting that under the microscope. Walk us through it.
Right, comparing nations to each other. I mean, in the S&P note today, they said that net debt here in the U.S. could rise to about 84% in 2013 if these issues are not addressed. Now, it seems like everybody measures debt by different barometers, but if you look at government net debt and you look at the U.S. versus other countries, particularly other countries that have recently been troubled, we're actually sort of in the middle here. The U.S. is 66% currently. This is from the IMF. Spain and Ireland actually lower by this particular measure. By other measures, they are higher. And then you go up to Greece, all the way up at 110%. So you just glance at something like that, it does seem relatively alarming. I mean, Brian, do you think that there is going to be enough consensus, even if this S&P call today is sort of a nudge in the right direction, that there's going to be enough to get that number down significantly?
Well, it will start to come down naturally just because of positive GDP growth, higher interest rates, and some inflation. And remember, that's good. I mean, we need to see a little pricing power again in our country, number one. Number two, the next great secular move in interest rates is up, and that's good too, because that means growth's coming back. And compared to all of those countries on that list, we're still the preeminent grower in the world. So let's not discount that.
We got to run. Brian, thank you so much. Brian Belski joining us from Oppenheimer and Company.